Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
So you've got a passion project, right? A side hustle that's starting to feel like, well, a real business. It's an awesome feeling. But then tax time comes knocking and things can get real complicated real fast. Today, we're going to demystify two of the biggest deductions for small businesses and, frankly, two of the most audited: your car and your home office. We're going to break it all down so you can claim what you're owed with total confidence. All right, to make this real, let's talk about someone. Meet Tom. By day, he's a high school teacher, but by night and on weekends, he crafts this incredible custom furniture. What started out as just a hobby is getting serious. People are actually paying him for his pieces, and he's starting to dream bigger, maybe even opening a store one day. This is that perfect moment when a passion starts to generate real, actual income.
And that income, well, that income leads to the big question. Tom just got paid $3,500 for a dining room table he built. So first off, does he have to report that? Oh yeah, you bet he does. But the real question, the one we're here for, is about the other side of the coin. Can he deduct the costs to make it? You know, the wood, the fancy varnish, the new sander, all those trips to the lumberyard? That's the puzzle we're going to solve.
Okay, but hold on. Before Tom even thinks about deducting a single can of wood stain, he has to clear this first massive hurdle. He has to prove to the Canada Revenue Agency, the CRA, that his furniture making is a legitimate business, not just something he does for fun on the weekends. And trust me, that distinction is absolutely everything. So how does the CRA figure this out? Well, they've basically got a checklist. They're not just looking at one thing. They're looking at the whole shebang. They want to know, are you actually trying to make a profit? Do you have a business plan written down somewhere? Are your records in order? Or are all your receipts just stuffed in a shoebox, you know? It all boils down to this. Are you acting like a business? If you can tick these boxes, you're in the game. All right, let's say Tom passes the test. The CRA agrees he's running a business. Now we can get to the good stuff, the deductions. And we're going to start with the big one, his vehicle. Every single trip to pick up supplies or deliver a finished piece is a potential deduction. But, and this is a huge but, you have to have the records to prove it. This is an area auditors just love to dig into because it's so easy to get wrong. And when we talk about proof, there's one document that is king: the auto log. I'm serious, this is not optional, it's absolutely mandatory. If you don't have one, an auditor can look at your claim and just say, nope, and throw the whole thing out. Poof, gone. Now here's a little good news. After you keep a detailed log for a full 12 months in your first year, it can get easier. You might only need to track a 3-month period after that, as long as your business driving habits stay pretty consistent. So why all this fuss about a logbook? It's because all those numbers feed into one fundamental formula. It's really just a simple ratio. You take the total kilometers you drove for your business, you divide that by the total kilometers your car was driven all year, and that gives you a percentage. That is your magic number, your business use percentage. Let's put some real numbers to this. Let's talk about Guam, a self-employed hairdresser. His log shows he drove 15,000 kilometers for work, going to clients' homes, picking up supplies, that kind of thing. His odometer shows the car was driven 20,000 kilometers total that year. Okay, so we do the math. 15,000 divided by 20,000, that's 75%. His total car costs, gas, insurance, repairs, the works, added up to $7,500. So he gets to claim 75% of that, which comes out to $5,625. See? Simple as that. Okay, so that percentage thing seems pretty straightforward, right? Well, here's where the government adds a little wrinkle, because of course they do. In the eyes of the CRA, not all vehicles are created equal. You absolutely have to understand the difference between what they call a passenger vehicle and a motor vehicle. This is a huge deal. First, you need to know that your car costs get split into two buckets. On one side, you have your operating expenses. This is the day-to-day stuff: gas, oil changes, insurance, even car washes. Simple enough. Then you have your fixed expenses. This is the bigger ticket stuff: the interest on your car loan, leasing payments, and depreciation, which has a fancy CRA name, Capital Cost Allowance, or CCA. And it's this second bucket, the fixed costs, where the really tricky rules and limits live. And those limits all depend on your vehicle type. A passenger vehicle is basically your typical car or SUV. For these, the CRA puts a ceiling on almost everything. For example, the purchase price for tax purposes is capped at $30,000 plus tax, even if you paid $50,000. But a motor vehicle, like a pickup truck that Tom uses to haul lumber more than half the time, that's a different story. For those, the cost ceilings generally don't apply, which is a massive, massive tax advantage. And this really puts it in perspective. Let's say you buy a $40,000 sedan for your business. When you go to your taxes, the CRA basically says, that's a nice car, but to us, it's a $30,000 car. That extra 10 grand you spent, from a capital cost perspective, it just evaporates. It really makes you think about what kind of vehicle you're buying for your business. All right, let's shift gears from the road to your home base. For someone like Tom, his garage workshop is the business. Being able to claim expenses for that space is a really powerful deduction. But you guessed it, just like with the vehicle, you have to follow the rules to a T. So how do you even know if your home office or workshop qualifies? There are two main ways. First, it can be your principal place of business. So if you're a freelance editor and that desk in your spare room is your command center, you're good. The second way is if you use the space exclusively and on a regular basis to meet with clients. Think of a chiropractor who has a dedicated treatment room in their home. For Tom, that workshop is clearly his principal place of business, so he's good to go. And hey, this formula is going to look very familiar. It's basically the same idea as the car expenses. It's all about apportionment. You have to figure out the square footage of your workspace as a percentage of your home's total area. Then you apply that percentage to all your eligible household expenses. Let's walk through it. Say your home office is 250 square feet. Your entire house, the total living space, is 2,400 square feet. A little bit of division tells us the office is about 10.4% of your home. Okay, step one is done. Now you gather up all your eligible home expenses for the year. We're talking heating, electricity, property taxes, insurance, even a portion of your mortgage interest. In this case, it all adds up to $18,279. And now for the payoff. You take that 10.4% ratio and apply it to your total home expenses. The result? An allowable deduction of $1,904. Just think about that. That's almost $2,000 you can deduct from your business income just for using a part of the home you already live in. That is not small change. But there is one giant, non-negotiable rule you have to know for home office expenses. It's the no-loss rule. Simply put, you cannot use your home office claim to create or increase a business loss. So let's look at this first scenario. Your business has a profit of $3,500 before you factor in the home office. Your calculated expenses are $2,000. You're fine. You can claim the full $2,000, which leaves you with a net profit of $1,500. Perfect. Now, this is the crucial part. What if your profit is only $1,000, but your home office expenses are still $2,000? Well, you can't claim the full $2,000 and report a loss. Nope, your claim gets capped at the amount of your profit. So you can only claim $1,000, which brings your net profit down to zero. But here's the good news. That other $1,000 in expenses you couldn't use, it's not lost forever. You can carry it forward and claim it in a future year when you have enough profit. Phew, okay. We have covered a lot of ground here, from vehicle types to workspace ratios. So let's bring it all home and talk about the golden rules that are going to help you make these claims with confidence and hopefully make you totally audit-proof. First things first, there is a specific mandatory order for claiming your business deductions. You can't just do it any way you want. You have to start with your cost of goods sold. Then come your other operating expenses. Then your auto expenses, followed by capital cost allowance. And what's dead last on the list? Your home office expenses. And why? It's because of that no-loss rule. You need to know what your final profit is before you can figure out the maximum home office claim you're even allowed to take. So let's build your audit-proof toolkit right now. Here's what you need. 1. Keep that detailed auto log. I can't say it enough. 2. For your home office, just draw a simple sketch of the floor plan with the measurements and keep it with your tax files. 3. If you meet clients at home, an appointment log is great proof. 4. Always separate your vehicle costs into those fixed and operating buckets. 5. Understand the rules for your specific vehicle type. And 6. Never, ever, ever use home office expenses to create a business loss. Your new best friend is documentation. So we've unpacked the rules for two of the most valuable deductions out there. But the key here isn't just about saving money on taxes. It's about being organized. It's about being strategic. It's really about transforming tax compliance from this awful chore into a smart tool that actually supports your business's growth. So I'll leave you with this question. Now that you know the rules, what's one small change you can make starting today to turn your tax filing from a headache into a real business advantage?